Hello, everyone. Welcome to our second webinar on how to finance your life without the bank, which I attended the first one and I thought it was so intriguing and I couldn't wait to hear the rest of the story. So, Winnie Lau, I'm going to turn it over to you so that you can actually tell us the rest of the story.
Awesome. And it's a really informative session. And because part one was actually provided, if you haven't gotten around to watching part one, I highly recommend that. I'm not gonna spend any time actually introducing myself. If you don't mind, I'll just kind of get right into it, if that's all right.
Yeah, go for it.
Okay. So sure. Let me know when you see my screen.
We are good to go.
Okay, so you should see just a picture of me, right?
Yep.
All right, so Winnie Lau here, and I am here to put the power of, I'm here to put the power of financing back into your hands. And, one of the things that I really stand for is liberation, education, and prosperity as it relates to finances. And I do consider myself a pillar of hope from being at the mercy of the banks. And, in part one of Financing Life Without the Banks, really I just started uncovering the tip of the iceberg about what this really is all about. And I invited people to join me in this line, which is sort of the inconvenient truth of, finances. And I do that because even though it may not be fashionable at this moment, I sleep a whole lot better because of it. So a lot of the information that I'm covering here tonight is just like less than 10% of the Canadian population actually have been exposed to this information. So you guys are really ahead of the curve. Even a lot of the people that have been in the financial industry for decades share with me all the time that they've never heard how I've explained things before. So with that, we all have to start somewhere as it relates to this information. And, just because we didn't, a lot of us end up in this spot, especially when we move out, unless we had financial gurus in our life since we were, really young. But this is where I, at a point in my life, I ended up feeling quite this way. Like I just don't quite understand how all this money stuff works, right? So in part one, I really describe a lot more about how infinite banking, or the ability to become your own banker, and financing life without the bank is really a strategy about being able to keep a lot more money in our pocket. And Robert Kiyosaki really did say it the best, and I'll repeat it one more time. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. And so in part one, these are some of the things that we looked at. Like how does interest rates really work? How can we make the power of compounding work in our favor? And if we continue to do what we're doing, what's the problem with that? And where is it that we actually store our money? And again, if you haven't seen it yet, please go and check it out. So again, I want to always give credit where credit is due, and this is my modern day Robin Hood, Mr. R. Nelson Nash. He is the whole reason why anyone is sitting here with me tonight. Because he's the one that's given us the information so that we could become our own banks in our own life. And that Mr. R. Nelson Nash, who is still with us today. So again, what is IBC? IBC is not a bank. It is a thought process that represents a major paradigm shift. And like many of the great thought leaders like R. Nelson Nash, he states it really does all start with how you think as it relates to the finances. And again, this strategy is going to challenge us to rethink, unlearn, and relearn. So my hope is that, you ask yourself by the end of this webinar, what is IBC or infinite banking concept going to look like for me? And when you do that, you get to dig deeper into how this might look in the iceberg of things, and create some time with me to do that. And here's a guideline in terms of how you can base that decision of whether you want to sit down with me for 15 minutes, which is, first of all, do I like Winnie? Would I enjoy working with Winnie? Do I feel like Winnie has my best interest at heart? And could I see myself working with Winnie over the long term? That would be like a general guideline for you to consider if you want to book some time with me afterwards. So this may not be for everyone, and I'll just say that up front. And I'll honor your time as much as possible. And really, for those of you, this is what I've discovered over the last 10 years. Is really, there's two sets of people that I really find this may not be for. And one of them is people who have abdicated their finances to someone else and have given up hope around finances. And number two, if you truly believe that the government and the stock market are going to come through for you when you really need the money the most, then this may not be for you. However, if you still decide to want to stay with me, then awesome, because action really expresses your priorities. And I find that if you don't actually prioritize your life, someone else will. So welcome to part 2 and of the introductory case study to financing life without the banks. And this is where the wheels really come off, and you'll get a little bit of coaching from me to see what this looks like. So in part 2 tonight, we're going to cover the engine that drives this strategy, and what is it going to look like to buy a car the infinite banking way, okay? And then after that, it's sort of like a quick summary of when you buy a vehicle in this manner or anything in this manner, we can really start to see how I've demonstrated how we've successfully mimicked the banking business model at the me and you level. All right. So financing life without the banks. First of all, as a quick review, right now we take our cash and we buy, we buy everything that we want in a lifetime once that money hits our bank account. So tonight is really about interrupting that thought process, and we're going to run that cash through the infinite banking strategy instead to pay for the things that we really want in our lifestyle. And when we do that, we're going to increase the amount of cash in our pockets as a result of it. And when I say the infinite banking method, I am not talking about, using any of the big 5 banks at all. I'm talking about using the knowledge that's inside this book and applying it to a financial vehicle that has 2 buckets of capital. So it's like having a whole lifeline of credit that you're approved for all your life. And a common question is like, does it replace my checking account? And the answer is no, it does not. So let's look at the engine that drives this process, okay? Because I think this is what you were really wanting to dig a little bit deeper into from last time. Hey, Bridget?
Yes.
Okay. All right. So, Bridget, and I'll leave it to you if you wouldn't mind. If there's any... Recording? Yeah, she's recording, I think.
Yeah, I am recording.
Yeah, and if you wouldn't mind too, Bridget, if there's a chat box that or something that comes up in chat, can you just let me know?
Okay, I will.
Okay, thank you. Okay, so coming back to things. So let's look at the engine that drives this infinite banking process. What's the financial vehicle used to apply this knowledge? Well, as I alluded to in part 1, it's a whole life insurance contract, but it's a participating dividend paying whole life insurance contract that is being used to drive the ability to finance one's own life. So in order to really appreciate how it's possible to do that, I do have to answer the question, like, what is this contract? And we have to get to know it a little bit more. So let's do that. So line by line, the participating part of what this financial vehicle is called is that you are essentially the owner of your policy and you have control over its use and application. Secondly, the dividend paying means you are eligible to be paid dividends. So we all here are mostly entrepreneurs, right? And so as entrepreneurs, excuse me, oh my goodness, burping. Excuse me. I'm better out than in. So we are all, it's all possible to earn profit in our business, right? But it's not guaranteed. Profits are not guaranteed. And so therefore in the insurance world, if we're eligible to receive a dividend, which is like profit in our business, dividends are also not guaranteed as well, okay? But we can be. So moving on to the whole life portion, it's, this contract is able to benefit our whole life, okay? In my personal opinion, this type of contract is really life insurance because it actually benefits us while we are alive, okay? And then also the insurance part of it is it actually also provides an estate benefit. So it leaves money behind for those that we care about. And the last part is contract, which is a big deal. This means that this contract is held under contractual law, okay? It's bound by contractual guarantees. So in other words, this contract means that you're able to start a business that is designed to pay you dividends and access cash throughout your whole life. And it has living benefits and death benefits, and it's based on contractual guarantees. So not all whole life contracts are created equal though, okay? So an insurance broker, many of us may already have one, is a generalist as it relates to this process, okay? So, I'm just gonna point out the fact that if we needed heart surgery, we definitely want a specialist to handle our heart and not a generalist. So, because in the case of having a heart surgery, the specialist would be the greatest chance for us being able to wake up alive after surgery. And so I would just say that as it relates to this concept, I am an authorized practitioner and I am a specialist as it relates to this. So let's jump into the mechanics now of this contract. And so I know I've talked to Bridget a few times about this. She's not a numbers girl, or maybe she is, but detailed stuff can drive her crazy. And so some of us really enjoy crunching the numbers, but there's a good portion of us who tend to really start to glaze over, when it comes to a lot of details. So I just really invite you to take a look at this myth where it says, hey, you have to be good with numbers to be good with money. And it is a myth because the truth is, it's actually far more important to understand the concept behind the numbers to be good with money, okay? Because there's plenty of people I know who are excellent. They can add things up in their head, no problem, just like this, snap, snap, snap. But it doesn't mean that they're great with money. And it doesn't mean that they understand money either or how it works and how they can make it work for them in their life, okay? So there is a story behind these numbers, and I really urge you in this next section to really listen to how I'm guiding you through this story rather than get too carried away with trying to look at everything on the screen. So here we go. So let's start with the story by introducing Mr. Joe, okay? So Mr. Joe is a male non-smoker, age 50, and he's saving $1,000 a month right now, okay? This is the story. So Mr. Joe says to me, hey, Winnie, what is it going to look like for me to run $1,000 a month through this financial vehicle instead? All right, and this vehicle again is our contract. And so again, listen to me guiding you through the story. Avoid trying to look about everywhere to try to make sense of things. I will do that for you. So again, we're just going to start at the top. The top here is that it's based on Mr. Joe's life at age 50. And on this it's identifying that this is a whole life contract, okay? So I'm going to just show you what this possibly could look like for Mr. Joe. And underneath identifying that this is a whole life contract, it's saying life pay. Well, what does that mean? It means that Mr. Joe has the capacity to deposit money into this contract till he's age 100. Well, if he's starting this at age 50, that means he could put money into this contract until age 50 if he wanted to. And I say wanted to, and you'll see why. Now, with some of the whole life contracts that are out there, you can have contracts that are paid up in 8 years, some paid up in 10 years, some paid up in 20 years, and some paid only till age 65. But this one is all the way out to age 100. So now we jump down to where this little character is right here with the dollar sign. And right beside the dollar sign, it says dividend option selected, paid up additions. Now, first of all, this is like a topping, like the best topping you could have on your dessert. So let me ask you, Miss Bridget, you have to unmute yourself.
I am unmuted.
What is your favorite dessert, Miss Bridget?
Maple syrup on snow.
Okay, so snow is the base. And maple syrup is...
I have no clue why that came to mind tonight.
Very Canadian and very...
Hey?
Bridget, you need to say like, chocolate volcano cake or something,
I'm just not that much of a dessert person.
Okay, well so, and now pick one more topping to go on top of your snow.
Okay, we can switch it to ice cream. That's probably one of my favorites. So with caramel on top.
Okay, so maple syrup and then caramel. Okay, so let's just say maple syrup is your favorite topping, and then the second favorite topping is the caramel. So consider the maple syrup like the first topping of your dessert, and this other one that I've looped in very messily is the accelerated deposit option, which is overfunding. So these two items here are like toppings on a dessert that make your dessert better, but as it relates to your finances in this contract, they're like the two best toppings that you can get to accelerate your cash growth while you're alive, because the actual dessert is cash, right? So these two items, in essence, the function of these two items is to grow your cash better than if you didn't have them at all, okay? That's really the concept behind these two things. But like I said, dividends are not guaranteed, but they can pay you out a dividend every single year in this contract. Now, there's different ways that you can actually receive your dividend, but you can actually receive it in cash every single year if you want to, and then you can spend it on whatever you want. But Mr. Joe is choosing to have his dividends and reinvest it back into the policy. And then this accelerated deposit option underneath here, it's an option. It's not what's required to keep this contract going, but if we include it, that means your cash will grow better and faster. And when we take these two toppings and put them together, it actually increases our cash flow. Okay? Now, the story began with Mr. Joe saying, what would it look like to put $1,000 into this thing? So how did I split out this $1,000 that you see here? Well, $850 is going to go towards death benefit, and the other $150 is the amount that I'm going to pay for the second topping. Now, it's called different things with different insurance companies, so I'm just going to call it what it is overall. It's called overfunding, but this is an insurance contract, so we have to make sure that it stays in a tax-exempt state because it's insurance. We don't want it to become an investment, so it automatically calculates here for me that it can't exceed $148.70 a month in order for it to stay an insurance contract. So that's why $148 has been designated to overfunding and $850 has been designated towards insurance. All right, so what I've shared before is that, oh, there's someone, can you make sure all the other participants are on mute, please?
Okay.
So 10,215 is the annual premium that is required to keep this contract going, because that's 850.
I'm just looking to mute here. I can't remember where it's at. I'm looking.
Oh.
Robin, do you want to mute your phone? Oh, there we go. I have it now.
Okay.
Oh, I muted you, Rob.
Okay,
You're
no
good,
problem.
Winnie, now.
Okay, so what's required to go into this contract every single year to keep it going is 850 times 12, which is 10,215. Okay, so I think we're good to go in terms of what I've covered on this page so far. I'm going to move on, and you see this is that blown up character, and I'm going to introduce this character now, and this character's name is Pua, right? So otherwise known as paid up additions. And so again, his direct function is he grows the living cash box and the death benefit at the same time. And that's an important role that Pua plays. So again, this contract, it comes with two assets that grow together at the same time. So one asset is the living cash box for the, for the whoever owns this contract. This is money that is accessible to you while you are alive. And then there is also the death benefit cash box, for the beneficiaries of the policy. I don't know. Anyways, so
I think we should put the money in those two.
Okay, so now again, please stay with me and let me verbally guide you, and try not to veer off too much by looking at all the numbers and trying to make sense of them. Okay, so you'll see here that what's highlighted is a living cash box hovering over this one column here, which is called cash value. So cash value is what is available to you while you are alive. And so for Mr. Joe, this is the money that he has access to, okay? And then here in the death benefit column, well then it kind of speaks for itself. This is the money that is going to be left behind for his beneficiaries. The other side is, let me just introduce this a little bit. So Mr. Joe started this contract at age 50. He went through the medical and he got approved. And so by the end of, you'll see here in the far left-hand column, at the end of year 1, he's age 51. At the end of year 2, he's age 52, and so on. You also see two distinct sets of columns. One's guaranteed and one's non-guaranteed. The one with guaranteed only has 3 columns, and the one that has non-guaranteed has 4. And the main difference of why non-guaranteed has 4 is because dividends is the 4th column, because dividends are not guaranteed, as you recall. So this side, the one with 3 columns, is actually really the worst case scenario. If all you did was pay for the required premium, didn't have your second topping of the overfunding, then at the end of year 1, if you don't receive a dividend, Mr. Joe actually receives this much in cash, right? And his death benefit would just remain the same if he never receives a dividend. So there's the pattern on both sides. So let me backtrack here. I'm getting a little excited. What's in common for both sets of columns is that the premiums are the same, regardless of whether you're buying the second topping and getting overfunding or not. If you decide to just pay required, then that is what it stays for the rest of Mr. Joe's life. Or if you want to pay for that second topping to produce more cash flow, then that also stays the same.
Can I stop you there? So
Sure.
When you talk about the first topping, that would be the $1,000 a month that you're investing.
850 of the 1,000.
And you consider the second topping the remainder?
Yes.
But, okay, so that's a bit confusing. So I invest $1,000 a month.
Yep.
Okay.
Well,
And
Mr. Let me just rephrase that. Investing, we have to be very careful with the words that we're using, because insurance, this is still an insurance contract. So when we say the word invest, it's like you invest in RSPs, you invest in TFSAs, you invest into the stock market. Investing implies that there's a risk of loss of capital. Okay? So here we're saying Mr. Joe is deciding that he wants to deposit $1,000 into here.
Okay.
Okay. just broken out into different things. So the next piece here is that, actually here's what I want to go through next. So that's the death benefit column. I want to jump here to, this is really important, because once we understand this contractual rule, it answers a lot of questions that tend to come up, that I've noticed that come up a lot in this past 10 years of going over this concept, is that the cash value and the death benefit has to equal the same by age 100. So if we jump all the way down to when Mr. Joe turns age 100, so you see in the very far left-hand column, at age 100, which is the bottom, which is 50 years later because he started at age 50, his cash, like his death benefit is 273. It never changed, but notice that his cash value is the same. The cash value and the death benefit must equal the same by age 100. And very same, even if he was paid dividends every single year, the cash value and the death benefit also equals the same by age 100. Okay, so in order to understand how the mechanics of this contract works, understanding this contractual rule will help. Okay, so we have to understand that the cash value is chasing to meet the death benefit by age 100. Does that make sense to you, Ms. Bridget?
Not really.
No? Okay.
Like I understand, so I invest, so I don't understand the two columns. So this is, on the left is what's guaranteed, and on the right is what I actually have, or like
on the right is what you're most likely to have, because over the past, dividends are most likely what's going to happen. That is something that I actually missed from the very top. So not looking at the screen for just a quick moment, the history of dividends in Canada. Canada is not a very, it's not a very old country compared to the rest of the world. So we have statistics all the way back from 1848 with Canada Life, with this contract, that have paid out a dividend every single year. That's over 170 years. With Sun Life, another known name in Canada, it's over 130 years of a dividend paying out with these sorts of contracts. The one that I'm showing you here is with Equitable Life of Canada. They've paid out over 95 years in a row. So just imagine what has happened over, over that time span, over 2 world wars. So much changes, recessions, everything, and yet these companies have been able to pay out a dividend every single year despite, right? So that's a really long-standing track record history. Okay, so the likelihood of what's going to happen for Mr. Joe is absolutely going to be the side where it has 4 columns and where it has a dividends on this side. That helps to answer. What I now want to explain to you is, why is there such a huge difference between 273,000 and 1.4 million, right?
Mm-hmm.
That's a pretty big deal. So that's where I'm going to go next. So with that, so this is sort of like a graph, a way to look at it graphically speaking, that if it was no dividends, then really since the start of Mr. Joe's contract, his cash would grow every single day till it meets 273,000, or if it's chasing the side where Mr. Joe is actually receiving dividends, then his cash has to grow every single day to meet 1.4 million. Okay, so that's just a sort of a quick visual of how that might look. Now, again here, please just pay attention to where I'm guiding you. I'm going to start really right at the top with the orange and the green circles. To start breaking down, why is there such a significant difference between the guaranteed side and the non-guaranteed side? So first, what I want to establish is with the orange circle. So in this bottom left-hand corner here, what I've done is over the first 3 years, I've calculated the difference in growth, cash value growth year over year, for the from the birth of the contract to the end of year 1. So at the start of the contract, when Mr. Joe was age 50, and then by the end of year 1, he's 51, it says here there's a cash value growth of 97.47. So at the end of year 1, that's what Mr. Joe has access to. So I wrote in 9747 right there. At the end of year 2, Mr. Joe Mr. Joe's cash value grew by an additional 98.78, not like the difference between these two numbers. It actually grew by another 9,878. And how I got that number was I took then what the cash value was at the end of year 2, which is 19,625, and then I deducted 9,747 from it, and that's what 987, where 987 comes from. And so I did that one more year in a row where it's okay, what's the cash value growth between years 3 and 2? So I took 29,981 minus 19,625, and it turned out to be an additional 10,356. So if you add these three numbers together, that's what equals out to 29,981. So I just want to assert that there's a pattern here, that the general pattern is that year over year, the cash value, it grows more than it did the last year. Okay, there are certain cases where it doesn't happen all the time because it just depends on whether you're female or male, and there's different age banding and there's different age categories in which, you know, we're also more susceptible to mortality than others. But the general pattern that I want you to understand, the general concept, is that the cash value tends to grow more than it did the year before. Then I want to establish the green circle. Same thing. I calculated, because this is what Mr. Joe starts off with, the amount that he pays in, that's what he purchases in death benefit. And so that's what he starts with. But at the end of year 1, if we scroll all the way over, it grew by an additional $285,621. Sorry, no, it grew to. It didn't grow by, it grew to 285. So I took 285 minus 273, and so the death benefit difference was 11,943. Okay, that's where that number came from. Same thing for the next 2 years. I took what was the death benefit at the end of year 2. So now it's 298,002, and I minused 285,621 from it, and then that equaled out to 12,381. So again, there's a bit of a pattern. Same thing. It grew by an additional 12,000, but it's more than it was than the year before. Same thing with the third year. I took 310,888 minus 298,002, and there's more growth than the last.
There's a question. Robin had a question in the comments if you want to have a look at that.
Do you want to just read it out loud to me?
Is this the premium paid over the year and the interest to arrive at the year 29878?
Right here?
To arrive at the year 2, so 9878. She's asking, is this the well, let me unmute you, Robin, because there's no reasons to have you muted. You are good to go.
Hi.
Hi.
Robin.
I was referring to the cash value. So you had said year 1 is 9747. This is in the orange circle.
Yep.
Actually, the hand-drawn one. And then year 2, it was the addition was 9,878. And what I was wondering is if you go up to the top right again, is it the 12, like, is that added 9,878, is that the premiums that were paid over the year plus the interest or whatever accumulating thing it is? Like, I was just wondering, it doubled. So from year 1 to 2, it doubled, right?
Yeah, it more than doubled, yeah.
Yeah. So is that, if it was me, is that my premiums going into the pot?
No, this is money that's available to you. So this is completely separate from Mr. Joe putting in and depositing $12,000 a year, right? This is Mr. Joe putting $12,000 a year, and this is money that's available for him to access.
Okay.
But it's not interest.
Okay, I got you. So I'm referring back to the other presentation. Am I right, of seeing the two pots, the Mr. Joe's pot of available money and then the insurance pot of...
Yes, I'm coming to that.
Oh,
so Yeah, I'm coming to that. So this is one pot right here, the cash value, right? This is one access to capital that an individual would have. And then the other pot that you're talking about is the general fund of the insurance company. And the general fund of the insurance company is like that huge pot of capital. So like, you know, the insurance company has so many different lines of business that they sell, right? They receive monthly payments for term contracts. They receive monthly payments for whole life contracts. They receive monthly payments for segregated, like whatever they receive. They receive money on a monthly and annual basis. That's the general fund of the insurance company. And we actually have access to that as well, because when we own this type of contract, not only do we have access to the dividends, we have access to the general fund of the insurance company too. Okay, so are we okay to sort of go on so I can establish the next pattern here?
So is the orange what is available to me if I am in I'm going to use the word contract of paying $12,000 in premiums per year?
Yes.
Is that right? Okay.
So, and I just want to clarify, so I'm paying $12,000 a year. A portion goes to the life insurance and a portion goes into dividend or whatever you call it. And that's where it grows.
Yes, there's two things that make it grow. I'm about to actually step into that.
Okay. I just wanted to make sure that I'm understanding the concept.
Yeah, and it actually may make a little bit more sense, I'm hoping, here. So this is what I visualize in the bottom right-hand corner here. This is what I visualize in terms of compounding working in my favor. This is how I see my money growing for me. I have many contracts like this of my own. So what's cool about this is like, so a death benefit, like, okay, first of all, as soon as Mr. Joe purchased this contract, the first main block of insurance that Mr. Joe purchased is $273,678. That's the first block of insurance that Mr. Joe created for himself. And once a block of insurance is created, that block of insurance has the ability to receive a dividend every single year until Mr. Joe graduates to the next life. Okay? And so a block of death benefit is like having a block of business that he could be paid a dividend on every single year. So you'll see here, we're right here, we're gonna talk about the annual dividend. At the end of the first year, it's illustrated and it's anticipated that Mr. Joe will get $2,224 of profit. And again, he could get it in cash, but we're gonna reinvest it to make more cash. And so you'll see here that the dividend for the first year is placed right here in this second tier. Now, there's another block, and this is the second topping. So this is the maple syrup, and this is the caramel right here. So the caramel is the EDO, or the overfunding, and the caramel always stays the same. The caramel is always the same. And where we get the caramel from is the overfunding, which is $148.69 times 12, which is $1,784.28 a year. So that always stays the same. Mr. Joe cannot overfund or cannot add more caramel to it. But the dividend can change. So the dividend, the two toppings work together, and they actually purchase a brand new block of death benefit. So it just so happened that the dividend and the overfunding created this block, which then if you add these two blocks together, that is where 285,621 comes in. That's why and how the death benefit increased to 285, because the dividend and the overfunding purchased the second block of insurance. Does that make sense? It worked together to purchase the second block. And so again, this dividend got paid out because it was paying on this big block of insurance right here, 273. Now, follow my logic again. In year number 2, Mr. Joe is going to receive $2,500 in a dividend. Why is the dividend higher than it was the year before? Well, it's because now there's 2 blocks of business, 2 blocks of insurance that he's getting paid a dividend on. He's getting paid again on this original block, and then now in the first time on this block that was just created the year before, right? And so now he's going to take that dividend and the overfunding, and he's going to buy a third block of insurance. And when you add the 3 blocks together, it creates the new death benefit at the end of year 2, which is 298,002, right? So just to cement this in one more time for year 3, Mr. Joe now gets a higher dividend at $2,823 or $2,823, yes. And that's because it's paying on 3 blocks of business, 3 blocks of insurance, this one, and this one. And so now this 4th block of insurance is created because the maple syrup and the caramel bought this block. And now the new block, so now, sorry, by the end of year 3, it's now $310,888. And it's because these 4 blocks of insurance are created. Does that kind of make sense? Can you see how it compounds on top of the other? And are you able to see why the dividends increase each year?
Because of the compounding.
Right. But the dividends increase each year because there's more blocks of insurance to pay on.
So my insurance benefits go up every year.
Your the death benefit.
The death benefits, sorry.
Yeah.
So that goes up every year, and is that like, does all the dividend, the return on the extra money that I'm putting in, does it go in there, or that always stays separate?
It's sort of, you have to organize. I would encourage that you organize it in your mind separately, because that's money being deposited, and then there's money that you can access. Okay.
Yeah.
Okay. So that's how I would organize it in my brain.
But on paper, so I bought a life insurance really for $273,000. I pay $1,000 a month.
Yep.
Is that a correct statement?
Yes.
But only a portion of that $1,000 a month goes towards that life insurance. The rest gets invested, or it goes into dividend or put in another box or whatever you want to call it.
Yeah. So I think what's important to understand here, first of all, is I think I still have a bit to kind of go through, and
Okay.
I think it might tie up a lot nicely. But
Okay.
the original contract was, the original contractual rule that I shared previous to this is that the cash value and the death benefit must equal the same by age 100. And I share this contractual rule with you because we want to use that contractual rule to our advantage. There's a reason why I'm setting this up where the dividend is, the death benefit is growing every single year, right? So if some people really don't give just don't give a crap about death benefit at all, but some people do, right? But the point of why we want to increase the death benefit here is because if we increase the death benefit, we're forcing the cash value to grow with it. Because what we want is we want more cash while we're alive, because that's when we need it.
Yes, we do.
Right? So we're forcing the death benefit to go up because we're forcing the cash value to go up at the same time. That's why we're doing this.
Okay.
Okay. So now, just to add that, we've already covered this, we've covered this, and here's just sort of like another way to visually look at this. If Mr. Joe started at age 50, his cash value is growing every single day, whether he receives a dividend or not, to meet this number. Well, 365 days later, and him being 365 days closer to age 100, we've now forced the death benefit to go up, and now the cash value is having to chase this higher number. So therefore, increasing the pace at which that cash is growing as well, right? At age 52, we forced the death benefit to go up to 298. So at age 52, we're now the pace at which the cash is growing is now growing at a steeper and quicker rate to meet that new number, and so on. So if we can just imagine, if this is the pattern that we're establishing, then this is the rate at which our cash grows every single year, and on that positive growth, that what we're looking for in anything when we want to see our cash grow. Okay, so some conceptual things to really understand. So going back to all of this, this is not saying that it will happen at year 6 and like, you know, certain specific places in every single contract, because it's different for everybody. A contract for Janine is going to look a little bit different than what it's going to look like for you, Bridget, and it's going to look a little bit different than it would be for you, Lorna, and same thing for you, Robin. Okay, but what you want to get is just the concept. So the growth, there's going to come a time where the cash value growth in 1 year is going to be greater than what Mr. Joe is actually depositing. So he's depositing $12,000 a year into this contract, but between years 6 and 7, it's actually, the cash value has actually, the growth has actually exceeded what he's putting in. So you can almost call it like, you know, that's the point where it starts becoming very profitable, okay? Now, a lot of people say, well, Winnie, you know, I'm still trying to wrap my brain around this. And if I was Mr. Joe, it just seems like a lot. Like I hardly talk to anyone who puts $1,000 a month into something like this. What if I can't put any money into this at year 2? What if I don't make enough to put $12,000 into it, right? Which is a valid question that a lot of people ask me. So I say, okay, well, what do you have at the end? What do you have in cash value by the end of year 2? Is there enough there to use for next year's premium? Yes, there is. What happens if Mr. Joe says at the end of year 1, I'm having a hard time seeing how I'm going to come up with year number 2's premium? Well, he could use the cash value, and he could use next year's premium to subsidize to pay for next year's premium as well. And I'm sharing this because there's actually a lot of flexibility inside this contract. What I'm saying is your money is not locked up. Yeah, it's just not locked up, okay? That's what I'm sharing. And I'm sharing that there's flexibility, you know, and plus what's required to keep this contract going is $10,215. So he could take the 9,747, take part of the dividend, and, you know, pay out next year's if he wants to. Okay, the second milestone that I want to point out in this contract is that there's going to come a point where Mr. Joe can access every single penny that he puts into it. Okay, and more. So it happens to be at year 11 here. So $12,000 times the 11 years equals $132,000. Well, at year 11, at the end of year 11, the accessible cash value, he's exceeded that. Okay, so that's why the characteristics inside this financial vehicle is stating, hey, you know, this is not an investment vehicle, right? Because it's actually a forced savings vehicle in a lot of respects, because what we expect out of savings is that every single penny that we put aside is going to be there for when we actually need it the most. That's what we really expect out of savings, okay? So I want to point out 2 more milestones. One is that, hey, look, there's going to come a point as well where the dividends can actually pay for the annual premiums as well, because there's so many blocks of insurance that there's lots of dividends because there's so many blocks of insurance to pay out on, right? A lot of traditional financial advisors would advise that, hey, you know, if you really see this as an expense and you really don't want to keep putting money into it, you could literally have your dividends pay for your annual premium, and you never have to deposit any more money into this contract if you don't want to. That is a possibility, but I would never advise that. I would rather you take money out, like take out a policy loan, and I'd rather you take out a policy loan to pay for the premium, because if you start using the dividend to pay for the premium, you're killing the growth of your contract by doing that. I would never do that. Okay, but I'm saying though, it's possible. It's possible to do that. The next one is what really gets me excited, is that, say for instance, because there's so many centurions living more and more these days, Mr. Joe does live to be like 105. So he's able to deposit all the way out until age 100. So if we actually calculated what's the maximum amount that Mr. Joe could put into this contract? Well, if we calculate $12,000 times 50 years, that's $600,000 that he can deposit into this contract alone. But let's see, 5, 10, 15, 16, 17, 18, 19, between 19 and 20 years before he's even put that amount of money in, he already has access to that capital. 19 or 20 years prior to that. Now, if I hadn't explained to the depth that I've explained how that could happen, you would definitely say it's too good to be true, right? So even if let's just say at year 32, 32 years times $12,000, at that point, Mr. Joe has put in $384,000 into this contract, but has access to $625,000.
What happens if he accesses some of that money?
Then he has, what do you mean?
So the money.
Well, we're going to touch base on that when we borrow money to buy a car the infinite banking way. So, but that's pretty awesome. I'm just saying, right? This has nothing to do, like I've been a part of a lot of like different direct marketing, network marketing, different sorts of things, investments. You know, there's two ways we can earn income in this life. We either exchange our time for money, or we have money working for us. And that's passive income, right? We can earn passive income. Some people think we can earn passive income in network marketing businesses, but you still have to put effort into it. It's not true money working for you. Okay, this is one of the purest forms of money working for you that I have found, right? Because this is based contractually. This is not based on the stock market or anything. And this is not based on other people's efforts. This is based on a contractual guarantee. Okay, so I'm excited about it. And we haven't even used it yet, but this is the financial vehicle that Nelson Nash has said, this is the proper financial vehicle that you must use in order to finance one's life. Okay, now,
Robin does have one more question here. Not locked up, but what if you need to get out for whatever reason? If you use next year's premium, then what?
Then, well, the contract, so what happens is you don't have access to cash, like you don't have any saved money to access, but the money will actually still grow even though you took that money out. So you remember how there is a cash value growth of like $9,800 between years 2 and 1, Robin? Remember how there's like $9,800 or something?
Yeah.
It's still going to increase by $9,800. Even though
it was when you were talking about Mr. Joe say he was having a hard time coming up with the premium for the year, and that he could access the dividend that was available for him, or even next year's dividend. And I was thinking that's kind of digging yourself in a hole. Life happens, and you know, like the more you're
but you're not in debt though either,
right?
But you're not in debt either. You could. I'm just saying that there's that flexibility. It's just the whole thing is that once you get the momentum of this going, you really, once you understand the power of this financial vehicle and how it can play a role in your life, I would do, like, you would want to do anything to protect it, right? If you access and use the dividends, or you access money out of the cash value, it doesn't kill the contract. It does not terminate the contract. Your contract, you're still, even though you took the money out of the dividend, and even though you took the money out of the first year for the cash value, your cash value between what's supposed to happen between years 1 and 2 is still going to happen. Your money is still going to grow. And it has to, because the cash value must grow to chase the death benefit.
Can I ask why somebody would want a death benefit other than to leave a legacy for their family? Is that the sole purpose of it, is to leave a legacy for the family?
Typically, or for charities, or for business partners, or to make sure that they're not leaving anyone to pay the debt or the taxes or the funeral expenses. Okay. Or if you have a family, then they're not having to come out of pocket to pay for your children. There's lots of reasons.
This isn't life insurance, right? A death benefit is different from life insurance?
No, it is life insurance.
It is?
It's death insurance, really, is what it is.
So if Mr. Joe died at age 60 instead of 100, then the contract just stops at 60. Is that
So
right?
let's just take a quick second. So Mr. Joe's age 60 right here. Okay, let's just say if Mr. Joe used up all his money because he just went on a round the world trip, or he just paid out the rest of his mortgage at age 60 with this 116,000 in cash value, and then he passed away. He didn't pay any of that. He didn't pay any of that money back. Then his beneficiaries would get $116,000 less than the death benefit.
They would get what? The death benefit minus the 116?
Yeah.
Okay.
Makes sense.
Yeah. So I want to, any other questions at this point, because we're already at 7:30, and I still want to walk you through how to buy a car using the IBC method.
Sure.
So what do you want to do? This is, I know we're co-sharing this particular webinar, Bridget, but it's 1 hour, and I want to honor everyone's time. What do you want to do? Because we're not complete.
Yeah.
So what do we want to do?
Just keep moving forward.
Yeah.
Okay. So this is recorded. So, you know, if you guys need to leave, and you guys need to do that. And I apologize for not being on par with all this. So now we just step through the engine of this process. And this is a little bit about this is exactly how I felt once I really understood the financial vehicle and this whole life insurance contract. I was just like, my jaw dropped, and I'm like, I'm so freaking excited after everything that I've attempted in my life. Like, this just blows me away that this is an actual insurance contract. But again, just moving forward. So in part one, I asked this very significant question. If you had a choice of whether you would rather be the banker or the borrower, which one would you rather be? And of course, everyone wants to be the banker. And one of the other things that I said was, in order to understand like what it takes to be a banker in your life, you have to become the lender. But because we're so used to seeing the lender as the bad guy, it's almost like a shift in our brain of saying, okay, am I becoming the bad guy now in my own life? But it's not, that's not what I'm really saying. It's just, we have to really understand that we have to own our own debt going forward in our own life, because when we do that, we can keep a third more, because when we don't own our own debt, we don't own our own interest. That means a third of our income can dissipate to someone else's pocket. And if we can reclaim some of that money back into our pockets, just imagine the amount of choices and further financial flexibility we will have as a result of it. So the mind shift here that I'm about to really ask you to just invite you to go on is own your own debt going forward. Because if you own your debt, you own the interest in your life. And that is a good thing. Okay? So more money in our life is not less. So the truth is, debt can work against us unless we own our own debt. So this is a process and definitely not a product. And I'm going to demonstrate that by purchasing a car the infinite banking way. So before today, we knew that we could buy a car in cash, we could finance a car, or we could lease a car. Okay, those are the three ways to purchase a car. So today it's all about how do we do it this way. So Mr. Joe is going to buy a car now, and he wants to borrow. He wants to actually get a new used car, and he's going to buy a car for $15,000. And so here's the scenario. He's going to borrow $15,000 from himself. He wants to charge himself, get this, 12% interest over the next 5 years. Okay? So, I'm gonna show you this example. And what's cool is that doing it the infinite banking way is that he's still gonna come out further ahead. Okay? But let's just take a look here. So it generates a 12% interest rate, generates a payment of $334. So this is something I covered in part one, in that there's a difference between interest rate and interest volume. So again, the interest rate only determines the monthly payment, but the volume of interest is actually the physical amount of dollars it's going to take to do the deal. So 12% equals 5,020 in actual interest. So if we divide that into what was borrowed, that's actually 33.5%. All right, so we're gonna actually borrow $15,000 out at year 2 because there's enough money there, right? Do you see that? There's at least 19,000 sitting in cash value at the end of year 2 for Mr. Joe.
Yeah.
Okay. So that's where we're going to take it out. Now, let's just compare for 1 second. If you had $19,625 sitting at a regular commercial bank, CIBC, TD, TFSA, I don't care, wherever, right? And you took out $15,000, you're going to have $46.25 left. But there's an opportunity cost to doing it that way, even though you're going to just pay straight cash. And that is, if you were, let's say, earning, you know, you're with Tangerine or Manulife Bank, and they're giving you 1.5% for having the money sit in the account. Are they going to continue to pay 1.5% on 19,000, or are they now going to pay you 1.5% on the 4,600?
On the 4,600, of course.
Right. So we lost a little bit of interest earnings because we took that money out.
$10.
Yeah, but still, you know, bottom line is that it was a bit of an opportunity cost there. So when we do it from Mr. Joe's bank, it's as if there is only $4,625 left for him to borrow inside of his own bank, but it's as if he never took that money out and he didn't lose the opportunity to continue growing his money next year to $29,981. His money is going to continue growing as if he never took it out. And this is where the second bucket of capital comes in that Robin was sort of alluding to earlier on, which was that general fund of the insurance company. Okay, so here it is. So that's where essentially the $15,000 is going to come out of the general fund of the insurance company instead. Okay. So one of the other things that I want to point out here is that the payment schedule that Mr. Joe used was that he wants to pay himself back fully by the end of the year 5. So he took his money out at year 2. So 5 years later it would be at year 7. Okay. And so that means his cash value continued to grow in that 5-year period. Okay. So if we actually calculated the difference of cash value growth in that 5-year period, 75,698 minus 19,625, that's $56,073. Okay. All right, so here's a visual on what happened here. There's a cash growth of 56,000. Mr. Joe took out 15,000 and he charged himself 12% interest, which is a total of $5,020. Now, here's a bit of the breakdown. I'm adding an extra layer in here that I did not before, which is that when you take out money from the general fund of the insurance company, every insurance company, depending on who you work with, is different. So this, for Mr. Joe at this time, the insurance company is actually charging him 7% to take out the $15,000. Okay, so he's charging himself 12% interest, so there's actually a 5% spread. Okay, so out of that the 7% out of the 5,020, 29.26 went back to the general fund of the insurance company, and then the $2,093 is extra profit on top. Okay. So my question to you is, because a lot of financial advisors even, and a lot of people get really hung up on this, because some people may even have a home equity line of credit, which is a secured line of credit, and say, well, Winnie, I have like a $50,000 home equity line of credit that charges me 3.2 or 4.5% interest. Why on earth would I borrow from an insurance policy at 7% when I can just borrow from the home equity line of credit? Does that question sort of come up when I mention it that way?
Yeah.
Yeah. So bottom line is that number one, the home equity line of credit would own the debt and not you. And number two is, would you exchange $2,926 to ensure that your cash still grew by $56,000.
Of course.
Yeah, every day, twice on Sunday. That's what I would do. That's why it doesn't really matter if the insurance company charges me this, because the growth of the contract, like the growth of my cash is going to far outweigh the amount of interest that they actually charge me. Okay, so
I would assume you have to have enough money to cover the debt, though.
yeah. Oh, you can't borrow more than what's in there.
Okay.
Okay, this is not like a regular bank, like a regular
So
bank.
they let you borrow out of the pot. Your money that you have invested is guaranteeing what you borrowed, but it still grows while you borrow that money.
Correct. You can't do that in any of the other financial vehicle.
Mm-hmm.
And if you know about one, you guys, you better tell me. But there's, as far as I've researched, this is the only financial vehicle in the world that can do this in one place, where you can multitask your dollars and still use it and have your money grow at the same time. Okay, this is in part one, I described this as the sweet situation instead of the
Okay, the one part I don't understand is why would you charge yourself 12% interest? Like, that's the part why not just the 7, like it's just the 7 that the insurance company charges you?
Yep. The successful banking business model is this. They take deposits, they lend out money, and they charge interest. The banks charge interest above, they actually have a base rate that they have to pay to the Bank of Canada. So they always charge you a little bit more interest than what they owe, because they owe somebody something.
Yeah, but they're not charging themselves. Like, that's the part I don't get.
No,
it
but
increases your monthly payments if you increase your interest rate.
Yeah, you could. All I'm just saying, though, is that if we want to mimic the same successful banking business model, which we know that the banks do really, really well, is that they charge themselves a little bit of, like they charge interest, and that like their interest income is like into the billions. So all I'm demonstrating here is you could. That's absolutely, you have, anyone who has their own contract has the flexibility of just simply paying what the general fund wants and then not do any more. But what I'm suggesting is that if we want to really profit from our own financing in our own life, we would charge ourselves above and beyond. Because why?
So really, that would just be another vehicle to invest more money monthly, right?
Yeah, well, you're actually making the money instead of the bank by charging.
Yeah, but you're paying the money you're making, so
it's like saying that you're willing to. It's like saying that you don't value your money as much as the banks value your money. It's almost like what I'm hearing in a way, because
no, I'm saying you're going to give $12. You're going to take $12 to pay yourself $12. Like, that part doesn't make sense to me. Like, the rest all makes sense to me, but to charge extra interest payment, like, I take it out and pay it back in, like there's no gain really to me in there, unless it helps grow somewhere or does.
In actuality, there does. There is a whole life contract now that just came out at the end of June that if you do put extra money and overfund more, it does actually grow your cash a lot better. But that's intermediate. That's intermediate. And really it's a values-based thing. I'm just demonstrating what you could do and how you could do it. So sort of what I showed in part one is that what we're able to do here, this is the power of compounding working in our favor, where you're still getting an uninterrupted growth of your money and you get access to your money at the same time. So that's great, because in part one, it's sort of like you can't have both the growth and access to your money at the same time. That was the downer part of doing it the other way. So again, I just want to jump right ahead to here, which is, let's take a look at the final numbers here. So let's fast forward 60 payments later. Mr. Joe still had to deposit $12,000 each year right? So that's $60,000. Mr. Joe also paid $2,900 to the general fund. Okay, so this is money that's not accessible. This is some, like, you know, we have to organize that differently in our brain. So that's $62,926 versus fast forwarding at the end of the 5-year period.
Sorry, is that 7% from the car loan? Is that what that's
7% from the general fund of the insurance company. From the, like, when we borrowed 15,000.
Okay, yeah.
General fund, yeah. So, and then underneath where we go to accessible cash value. So in reality, the cash values that you see at the end of each year, the life insurance companies really only allow you to access 90% of those cash values each and every week. Whatever's there, they allow you to access 90% of what's there because 10% is always left behind for padding. So I kind of just showed you, so this is the more conservative number. So what you have access to at the end of year 5 of the 56,000 that grew in that 5-year period is 50,000, okay? And then you have the extra $2,093 that you paid in interest. And then you also repaid yourself the $15,000, right? Through that 334-month payment. You guys track with me so far?
Yeah.
Okay. So what we have left in liquid funds at the end of year 7 is $67,559. Okay. So if we actually came out to a positive difference of $4,632.68. Now let's just say, Bridget, you didn't want to pay the extra 5%, right? So even if we took out the $2,093, we would still come out further ahead. Would we not? Even if we didn't pay the extra interest of 5%. So there's a major difference here in what just really occurred. And this is a huge deal because typically people, this is the, I just want to go back this slide right here. If you had cash, you had $15,000 in cash and you spent it to buy the car, this is where, you know, you basically are back down to zero and then you have to save again until the next thing comes along, right? What really occurred here in the infinite banking way is that we spent the $15,000 and as we were paying ourselves back, our cash grew. And by the time we were done paying ourselves back, there was more to borrow from than when we first started. Because at year 2, we had $19,625. By the end of year 7, we had about $75,000 in there, right? So if we did the same thing, if there was $75,000 in there, and this time you really want a new car, you could buy a brand new car. Well, maybe not a Beamer, but, right? But you could, and then as soon as you were done paying yourself for that, there was more money to borrow from than when there was first started. Okay? So with that being said, Mr. Joe is happy because he came out further ahead. And it also defines the principle of what Nelson talks about, which is, you know, everything you buy, you either pay interest to someone else or you give up interest you otherwise could have earned. So those who understand how interest works earn it, and those who don't pay it, right? And just to skip ahead on to how does this model how you take deposits, lend out money, and charge interest? Well, Mr. Joe was able to do all of that on his own using this financial vehicle because taking deposits is him depositing $12,000 into that financial vehicle, a whole life car contract. He lent himself money by doing a policy loan from the cash values, and he charged himself interest, right? So he was actually able to play all 4 characters in the play because he owns this contract. Okay, that's why he's able to receive the dividends. He was able to also play the banker in his life. The banker is the one who determines the sort of the situation of how to pay himself back. So he decided that he wanted to pay over 5 years at 12% interest. So if you're your own banker, you can do whatever you'd like. And he was also the one who borrowed from himself, and he was also the one who saved. He did all four. And so when you can play all four characters in the play, it becomes almost impossible to lose cash. Which means there's also a lot more flexibility, because let's just say Mr. Joe, here, I just want to stop sharing now for this, because I don't need to anymore.
Just want to let you know I have to go very soon, so I can leave it running if you need to. I'm gonna have to go.
Yeah, no problem. So the really great thing about this is that Mr. Joe really could have not started paying himself back if he didn't want to. I mean, if Mr. Joe came to me and said, look, Winnie, I haven't been working for 6 months, it doesn't really matter because it's his money. He can access it whenever he wants. If he wants to take a 1-year holiday payment before he starts paying himself back, he absolutely could. There's just a lot more flexibility inside of this contract. So with that being said, yeah, that's pretty much the general gist. I was able to walk through all the things that I wanted to walk through. The engine, knowing how to purchase, you know, a car, like something very basic that everyone needs in this country, how to do it the IBC way, how it's possible to come out further ahead, and how it mimics that same successful banking business model at the me level. And that's generally about it. If you want to create some time with me, it's pretty easy.
Oh, are you
Sorry,
there?
Yep, it's just a little bit of an echo.
I'm just unmuting. I just unmuted everyone. So if anybody wants to talk to Winnie, or how can they get a hold of you? Are we going to follow up with an email with your contact info?
Yep, can do. Yeah, I really appreciate it. You know, this is like way over time. So if there's any questions that you guys want to ask me, you can book a 15-minute session to just hash out all of those questions and clarity for yourself. Absolutely be happy to do that.
Was there any quick comments right now, guys? Or like I said, I will follow up with an email with Winnie's information as well.
That would be great.
All right, perfect, ladies.
Well, thank you very much, Winnie. It's very fascinating. Excuse me, I get pretty much all of it. It's a little complicated, and there's a lot into there, and it's like a little bit hard to understand at times, but for myself anyway, I do get it. I get the concept, and I do like it.
Guys, yes, I know we've had lengthy conversations about, you know, some people are just get wiped out pretty fast from having all these details thrown at them, and so I understand. But I know for some people, there's some people that really appreciate a lot of the details. Otherwise, it drives them batty crazy. They don't get them. So.
All right. Well, thank you, everyone. And we have the recording for this, so we'll also be sending out the recording.
Awesome. Thank you so much, everyone.
Woohoo! Thank
And
you
Bob.
very much, Winnie. You are brilliant.
Thank you.
Bye, Janine. Bye-bye.
Bye.